Hello, and welcome to another installment of Tax Stuff You Should Know, a podcast that's brought to you by the law firm of Aaron Fox Schiff, LLP. My name is Bob Pluth. I'm the co-leader of the tax practice group at Aaron Fox Schiff, and I'm joined by my esteemed colleague and partner today, as always, Gene Magidenko. Gene, how are you today?
Fantastically well, Bob. How are you?
I'm great. Getting into the groove of your summer?
Oh yeah, well, summer's closer to being done than the beginning, I guess, but that's the way it always seems to go.
Absolutely. My mother-in-law, God bless her, always used to say at the 4th of July, summer was half over, which isn't quite true, but I understood what she was saying nonetheless. Anyhow, today we're talking about profits interest. This is a really powerful tool that we have for partnerships and LLCs that are taxed as partnerships, particularly if we want to reward service providers uh, in the business that either don't have or aren't in a position for whatever reason to contribute significant dollars to become partners. Uh, Let me start us off by laying out a quick example. Let's assume we've got Nuco LLC, which is a manufacturing company. It's got an enterprise value of $10 million. Dollars. It was founded by uh, A and B, each of whom own 50 Class A member interests. Okay. So they're the founders and they've created this business. They've created some significant value, but let's assume that they're technical guys. They're not business guys necessarily. And they have bumped into C, who they'd like to bring on as their CEO to sort of run the business from the business end. And they'd like to offer C a 10% interest, quote unquote, 10% interest in the business. And let's assume finally that C doesn't have any money. So he's not in a position to make a capital contribution, but he's very anxious to join Nuco as CEO and as a partner. Um, if A and B merely transferred 10%, that would be roughly 11 new Class A units, let's say, either issued by the LLC or transferred some of their own to C directly, that have every economic attribute that the founders had. Those units would be worth $1 million, 10% of the 10 million enterprise value that we've anticipated here. Uh, C would have $1 million worth of ordinary compensation income because that transfer is being made in consideration for C's joining the company and in consideration for future services that he'll provide. So that's a real problem for C. He's got significant income tax liability on receipt, and he's got no cash. He's got a closely held business interest, undoubtedly valuable, but it's not something he can turn into cash readily. The company immediately before C is brought in has a $1 million, compensation deduction, which flows through to A and B. So that's kind of a good deal for them, but it's a disaster for C. So the alternative, uh, and this is where the profits interest comes in, is that what we can do is have C issued by the LLC. Let's call them participating units just to distinguish them from the A units. We could call them B units, we could call them whatever. That entitle C to 10% of the operating income of the company, along with 10% of the future increase in value of the company over and above the current $10 million in value. And just to focus on that for a moment, what we're talking about is a situation then, since let's assume that Nuco, while it's a manufacturing company and while it's successful, its day-to-day profits are unknown and unknowable. They are not determinable with any degree of likelihood, let's assume. And in that circumstance, we can take the position that what C has received has no value on the date that it's actually given to him. And we do that by virtue of looking at the liquidation value. And Gene was going to get into this in a bit in terms of how the IRS views these things. But the enterprise value, while it's worth $10 million, if we were to liquidate immediately upon C getting these units, he would get nothing. There hasn't been a dollar of new profits from operations that have been earned as of that time, and there's not been a dollar, let's assume, of additional appreciation that has been generated as of that time. So if we did a hypothetical liquidation immediately after C gets the units, he'd get nothing, and so as a result, for reasons that Gene can walk us through here in a moment, he can take the position that he's got nothing of value that's taxable for federal income tax and state income tax purposes, even though clearly he has something of value in the sense that he'd much rather have the units than not. After all, he's bargained for them, let's assume, in connection with joining the company to begin with. So that's the distinction that we were trying to draw here, the difference between the ability to participate in future upside potential of the business, profits interest, non-taxable, versus if he were just given the across the board capital interest by A and B, he'd have an immediate, undeniable $1 million in value received, and as a result, $1 million of ordinary income and a big tax problem. Now, prior prior to the IRS revenue procedures that Gene's going to talk about here in a moment, there were a number of cases during which these kinds of issues were litigated. Uh, there was a case called Campbell versus Commissioner years ago, for example, that held that profits interests in that case were not capable of being valued. And as a result, the Eighth Circuit Court of Appeals said that the recipient had no taxable event. It also, in dictum, suggested that profits interest per se were never a taxable event. The Seventh Circuit, in a case called Diamond versus Commissioner, came out differently and basically said in that case, and not to go into the facts deeply, but it was a fairly clearly disguised, if you will, fee interest that the recipient received, a real estate fee, real estate based fee. Since that fee was, determinable, readily determinable on the time of receipt, there was an immediate taxable event. The cases were ultimately mixed, but after probably losing more cases than they won, the IRS finally conceded the issue with a couple of revenue procedures.
Yeah, thank you, Bob. That was I think, a great summary of the lay of the land. Going back to the Diamond case, I agree that that was probably a bit of an outlier, and what was really driving the decision there was that the issuance of the profits interest was followed pretty closely by a sale of that interest, which kind of defied the logic that was applied in a lot of other cases that this interest is difficult to value or incapable of having its value ascertained. Where obviously you have a sale that very closely in time follows the issuance. It's generally safe to say that the value of the interest perhaps is ascertainable when it is granted. But as you said, there was some uncertainty there. A lot of cases, most of them taxpayer friendly, but not exclusively. And
Mhm.
so in 1993, the IRS decided to provide some guidance and some certainty to taxpayers, at which point it issued Revenue Procedure 93-27, which provided a safe harbor for the tax treatment of profits interests. So in that case, in that revenue procedure, the IRS said that they would respect a zero value of a profits interest, and again, a profits interest for this purpose being an interest that has zero liquidation value on a hypothetical liquidation that would occur immediately after the issuance of that interest, that the IRS would view that as a zero value award upon issuance if it fulfills certain criteria. So, first of all, the profits interest has to be issued to or for the benefit of the partnership in the partner capacity to the service provider or in anticipation of that person becoming a partner. It cannot relate to a substantially certain and predictable stream of income. So, for instance, high quality debt securities or high quality net leases. So, there has to be some potential upside or downside risk. It can't be disposed of within 2 years of receipt, and it can't be a limited partnership interest in a publicly traded partnership. Once you fulfill those criteria, you're within the safe harbor of the revenue procedure, and the IRS will not try to claim that the profits interest is worth anything other than zero when it's awarded. I suppose it raises the question of, well, what happens if you're outside of the ambit of this revenue procedure? How does the IRS treat it in that case? It's perhaps a little less certain, though it's only a safe harbor. The revenue procedure is only a safe harbor, so the IRS could certainly still treat a profits interest as zero value if it's outside the criteria that are set forth in that guidance. And certainly a taxpayer could take that position, but you're being outside the safe harbor, you are subject to perhaps a little more risk, a little more uncertainty in that case.
So, for example, Gene, a private equity firm could come along in 20 months uh, subsequent to the issuance and uh, make an offer that these folks just couldn't refuse, and there's a sale of the company that wasn't on the drawing board, wasn't being discussed at the time the profits interests were first issued. Uh, One would hope that would be a situation where the service would say, well, even though there's been a disposition within 2 years, it wasn't something that was in the control of C, or even discussed at the time the interests were issued, and presumably that would still be viewed as a good profits interest.
Absolutely. And obviously, there are a lot more marginal cases, perhaps, where a sale occurs within a year. Then it becomes ultimately a facts and circumstances inquiry, whether it is a non-taxable profits interest grant or whether it is a taxable event. Generally speaking, you want to try to avoid those scenarios, but sometimes, as you said, Bob, there will be cases where there's an unexpected offer to buy a company and potentially a windfall for the profits interest holder, and it does add perhaps a little element of heartburn in those cases, but nonetheless, there's still a strong case, and at least many of them, for a zero value when it was awarded in any event.
Great.
So after a few years, after the revenue procedure was issued, there was still some uncertainty about how do you approach substantially non-vested profits interests, because in a lot of cases, you're not necessarily going to want to issue a profits interest flat out. You may want to have some sort of vesting schedule. For instance, if it's a independent contractor or a service provider, an employee, former employee who has issued this profits interest, you don't necessarily want them to partake in a potential capital event right from the get-go, or potentially be able to share in the profits until they put in some time or maybe fulfill certain other vesting criteria. So in 2001, the IRS issued Revenue Procedure 2001 43, which clarified that even if you have a non vested profits interest, there's still no taxable event at the time of issuance, provided that the recipient of that profits interest is treated as a partner. And again, there are certain criteria to get there. So, first and foremost, both the partner and the partnership have to treat that recipient of the profits interest as a partner from the very beginning. So even if it's not vested, that person still has to be treated as a partner, meaning they have to receive a K-1. If they were an employee, they're not going to be an employee anymore. They can't receive a W-2. To the extent that they're allocable any items from the partnership, they have to receive those as well. Upon grant, as well as upon vesting, the partnership and the other partners, besides the one who was issued the profits interest, they cannot claim any deduction, whether for compensation, wages, or otherwise, with respect to the issuance of that profits interest. There is certainly a lot of logic there. If what you're giving out has zero value, then there's no deduction you should be able to claim with respect to that. You also have to fulfill all the criteria of the earlier Revenue Procedure 93-27, which also makes sense to kind of loop that into that earlier guidance. And basically, once you fulfill those criteria, you have a zero valued profits interest issuance, kind of reverting back to the time of grant, notwithstanding that there may be a vesting event at some point after the award of that profits interest, which in turn raises a question, Bob, I think, of how do you approach that from a Section 83B perspective? So Revenue Procedure 2001-43 says you don't have to make an 83B election in that case. It's not required. Nonetheless, it is standard practice and a good practice to make a protective election in that case, and it's something that we recommend doing in the off chance that something goes awry. For instance, what if you have a sale within 2 years?
Mhm.
Uh, the the protective 83B election is kind of what provides you additional peace of mind, if you will, in that type of a scenario where you don't necessarily have to worry. Well, maybe I had my interest purchased within a year and a half. I'm outside of the scope of the revenue procedures. I'm outside the scope of the safe harbor. Does that create some sort of potential issue? And this is especially a concern where you have unvested profits interest. Does the vesting of that profits interest cause a recognition event? And so that's where the 83B election, even if filed protectively, can do a lot of work.
And that's an election made by the recipient.
Correct. Within 30 days of the issuance or the original grant of the profits interest.
Terrific, terrific. Uh, Great. Well, we've touched on a couple of these things already, but there are a number of design elements of profits interest, uh, bearing on the amount of flexibility that we can have in drafting partnership agreements or LLC operating agreements. So, for example, and this leads to some of the confusion in the area, almost always you would see a profits interest granting the right to participate in proceeds upon the sale or other capital event. So, sale of the business. Another capital event might be a dividend recapitalization where the owners don't sell the business, but they go to a friendly banker and say, hey, we've created a $10 million business. We don't have any debt on our books. How about you lend us $5 million, which, by the way, we're going to distribute to ourselves and take some of our investment, off the table. But the company will have adequate profits to repay you. And that's not an uncommon transaction. Uh, Separately, but often in tandem with the right to sale proceeds, is the right to participate in operating income as well as in the capital event proceeds. Now, in some cases, that's somewhat academic. If you're building a new business with the view of selling it, chances are that you're reinvesting all of your operating profits anyhow, and you're not making distributions to the owners other than maybe to allow them to pay their taxes on the flow through of the business income, if you will. Gene, you had mentioned vesting. Vesting is quite common It can be based on time. It can be based on performance. Uh, Time being, it would be typical for interest to vest, say, 20% a year over a 5-year period. You want to put the golden handcuffs on Mr. C in our example here to make sure that he's incentivized to stick around for the longest term, and to create some value. Performance-based vesting might be, you say to C, well, we want to have our profits increase by 5% a year for the next 5 years. And if you can do that, then perhaps you vest in some portion of your units. It's not just a matter of biding your time and staying with the company. Uh, I mentioned earlier that we've got this threshold amount, this threshold hurdle, if you will, that has to be reached before C gets any of the sale proceeds. That was the $10 million value on the date of issuance. It doesn't have to be that amount. It can be more than that amount, for example. If A and B want to make this a little bit more aspirational from C's point of view, they could say, hey, we've got to get to $11 million before you start to participate. That's perfectly okay. What they can't do and have a non-taxable event is they can't take that threshold amount below the $10 million assumed fair market value, enterprise value in this case. If they made it $9 million, then there'd be $100,000 of value in C's position, 10% of the $1 million in value that's not subject to the cap, if you will, or the threshold amount. So that would be a problem. Um, there's also kind of an interesting way to deal with situations where someone is coming sort of late to the party, where C might say, well, gee, you guys have already created a lot of value. I wish I'd have been able to join on day one. I'd already have $1 million in my account, if you will. Uh, and that issue can be dealt with by what we call catch-up payments, where what we could do is we could say that in the LLC agreement, let's assume, or the partnership agreement, the first $10 million of sales proceeds go to A and B, but the next $1 million, the amount that C feels that he sort of missed out on, could go dollar for dollar to C, and then split everything above $11 million of total proceeds in that 90-10 ratio, so as to put the parties in the same position for everything north of the $11 million amount. That's a possibility. This certainly puts a premium on knowing uh, to a pretty fair certainty of what your enterprise value is, realizing that sometimes it's more art than science, and the IRS could conceivably disagree. So, what you'd probably want to have in a case like this is a good valuation from a reputable valuation firm in the file, contemporaneous with the issuance of the units, so that you'd have a good evidence of why you set the threshold value at what you did. Other, just very quickly, a couple of other points in terms of design. The profits interests typically don't have voting rights, although there's no reason why they couldn't. They certainly could. Um, that's really a business decision more than anything. The profits interests have to be non-transferable, however. If they're transferable, then I think you start bumping into the safe harbors that the IRS has outlined. Uh, and more fundamentally, in Section 83 itself, where the recipient for services isn't in a position to turn his or her rights into cash through a sale, even though he's not maybe entitled to receive anything from the entity. So I think those cover the basic design elements. The last thing I would note in that area, however, is typically what you would see as a business matter You'd have A and B say, well, look, uh, do we have to issue anything to make any actual distributions to Mr. C to the extent that his units are unvested? We'd really prefer not to do that. And that's a fairly common and reasonable position to take. So typically, what we'll do is we'll have a different kind of a catch up payment that says to see, hey, look, if we make a distribution out of operating profits in the interim, uh, before your units are vested or fully vested, whatever we hold back, we'll give to you on the vesting day. So long as you stick around long enough for that to happen, or you meet your other performance objectives. Um, one exemption or exception to that rule, I should say, would be that since Gene, as you pointed out, C is a true partner, even though he's got unvested units, he's going to get a K1. It's going to have 10% of the income of the company on it. And let's assume the company makes $1 million a year, taxable income on average. C's got a K1 with $100,000 of income on it. And it's got a tax bill of, roughly $40,000, $50,000, depending upon which state we're talking about. And so tax distributions logically should be made to C. Otherwise, he's put in a really bad situation of having taxable income and nothing to pay it with.
Yeah, it's definitely a double-edged sword in that case, where you have the phantom income coming up from the partnership interest, but you're not entitled to get distributions until some point later. So, something to watch out for
Yeah,
sure.
the ownership of the interest becomes a mixed burden and benefit, and the whole idea here is to incentivize C to stick around, do a good job, and to make the business grow. So, Gene, what are the common situations that we see for using profits interest?
So I think first and foremost, it's we're really talking about situations in the partnership or tax partnership context. So LLCs, tax as partnerships, limited partnerships, and other similar forms. Not something you would see with corporations, but I can get to that in a minute. Primarily, this is to incentivize service providers, maybe existing employees who you want to bring into partnership, but in some sort of a managed way. For whatever reason, they may not be able to or be unwilling to make a capital contribution to take a full capital stake in the partnership, but you may want to incentivize them to have some percentage of the profits going forward or on the event of a capital event, if the company is sold or something like that. So that's really the primary situation is some sort of incentive, compensation form basically for service providers. It can be not just employees, but it can be independent contractors as well. So it's a very flexible form of compensation, if you will, or of a compensatory type of interest in those cases. And it's not just limited to natural persons or individuals. It can also be granted to entities as well. Although I think, generally speaking, the majority of situations we deal with are individual service providers, but it doesn't necessarily have to be. It can be issued to corporations, partnerships, or any other entity forms. Fundamentally, it allows a lot more flexibility in terms of structuring the partner's arrangement. So you can have different classes of units, you can have different vesting requirements, different threshold amounts, multiple classes with staggered, vesting or threshold amounts. This stands in stark contrast to corporations where you're a lot more limited about what you can do, where you largely have to issue options or maybe phantom shares or some other types of synthetic equity. Whereas you do have a lot more flexibility with the partnerships and with profits interests specifically In addition, with corporations, what you may be looking at as a service provider in that case is ordinary income, or at least some ordinary income component, setting aside incentive stock options, for instance, which are tax favored. Most stock options or most types of phantom equity awards in the corporate context are going to be ordinary income. With a profits interest, there's a lot more possibility for capital gain treatment, from that profits interest. And so it can be beneficial in a very significant and meaningful way to the service provider who is receiving the profits interest. And needless to say, as we talked about in our recent podcast, if you have an S corporation, you definitely do not want to issue profits interests because, well, first of all, it's a corporation and it would be a little odd for it to issue profits interest, but also you will blow up your S election, almost certainly if you do that.
I see. Good advice. Well, just to recap a little bit here, we've talked about all these things, I think, already. The impact on the holder then is no tax on receipt, no tax on vesting of the interest, no need to make a capital contribution or any other investment in cash investment in the company. You're investing your time and your services. Capital gain potential on liquidation or capital event. Obviously, ordinary income to the extent that you're participating in profits from operations, but that's unavoidable. Uh, Potential for dry income, that is a K1 with generating tax liability and no cash. That's why it's important from the holder's point of view, to make sure that there's going to be tax distributions that cover that situation. Um, and as you pointed out, Gene, no longer uh, either never being or no longer being a W two employee. And that would be true if C were already an employee of the company and then received these profits interest after receiving W 2s for, say, several years. And that just ups the degree of difficulty for C's tax preparation. Uh, you've got to deal with partnership, tax reporting, Schedule E, and some other things that hit your return. So as a result, these uh, profits interests aren't necessarily for the rank and file employees all the way up and down the line, even if the employer is got a big heart and would otherwise like to do that, just because the degree of complexity might be more than some people really want to deal with. Particularly if we can expand our example here a little bit and assume that we do business in more than one jurisdiction. And so now there'd be multi-state income tax filings, uh, uh, not just filing in home state or in the place where the business first began. So that there's a degree of difficulty there as well.
Yeah, absolutely. I agree. And that's an important thing to consider that really, as we mentioned, it would bring the employee potentially or independent contractor into the fold as a partner, a true partner. You have to treat them as a partner. In addition to the K1s, kind of everything that comes along with that, which can be fiduciary duties, kind of flowing both ways, potentially information sharing rights as well, although those can be limited to some degree in the partnership operating agreement. There may be also fiduciary duties owed by the service provider to the partnership as well, which should be considered, though obviously that's more of a burden on the service provider, in other words, the employee or the independent contractor, but that does change fundamentally their relationship to the entity. In addition, from a very quick, perhaps tax observation perspective, there's no compensation deduction, as we mentioned, for the partnership on issuing the profits interest, which flows from the zero value award, of course. However, with respect to any future profits that are allocated to that service provider who received the profits interest, there is in effect a deflection of income to that person, which means that the other partners, the legacy partners in that entity, are receiving smaller amounts of income. So that can approximate a deduction in effect, without perhaps some of the complexities that come along with that as well. So even if there's no deduction for compensation up front, any future profits that are sent along to that profits interest holder are not taxable to the other partners, because they're sharing in the profits just like any other partner at that point.
Terrific. One last thing that I'd like to just mention, which is the revenue procedures that you talked about. And by the way, both of those revenue procedures are going to be in the show notes that you'll be able to access uh, for the podcast. Uh, so if you're interested in doing a little bit of a deeper dive, they're not very long, mercifully, unlike many other revenue procedures. So you'll have access to them. Uh, but the IRS has not spoken in these revenue procedures outside of the context of sort of the normal transfer of property for services, but they haven't addressed family situations. So if this is father giving profits interest to daughter for services, uh, same income tax rules apply, but the IRS has intimated that for gift tax purposes, all bets are off, that the interest might well have a value for gift tax purposes that the IRS might want to have reckoned with at the time of the transfer. This goes back to sort of the inherent value that the interest has in it. Uh, we'll leave that with our esteemed estate and gift colleagues at the firm. But it's an interesting twist, and it's not a situation that is unheard of in a family type business where if mom and dad don't want to make an affirmative gift of shares, but instead want to create a situation where the next generation can earn some equity in the entity, you could well run headlong into that very issue. So, Gene, any final thoughts?
No, I think that was a very quick and dirty introduction to profits interests, but obviously the devil's in the details. So there are still some traps for the unwary there that yeah, that need to be navigated around in certain cases. But I think what it boils down to is it can be a very powerful tool for a partnership or an entity taxed as a partnership to use, to incentivize people and to allow them to share in profits without necessarily all the complexities of having people buy in as full capital interest holders in the entity.
Terrific. Well, folks, that wraps up another installment. As always, we really look forward to any feedback that you'd like to give us. You can reach out by sending an email or a request to taxstuff at afslaw.com. And feel free, if there are topics that you have a strong interest in hearing about in the future, we're happy to take those and hopefully come up with an interesting podcast on that very topic in the future. So thanks again. Gene, until next time, all the best, buddy.
You bet.
All right. Bye bye.